What if I tell you guys that there is like a very simple strategy that anyone can use? That's like it's pretty logical. It's like once you hear why it works, it's like it makes sense. It gives you the confidence to take the trades. And yeah, for me, I've been using this. It's been my discretionary system for like 2 years now, on and off. Like sometimes I just deploy automated systems and I don't do any discretionary trading. But sometimes I also like to do the discretionary trades, do it manual because it's also fun. I learned from this strategy from the founder of Lark Funding, Meet Metal. He uses a bit of a different approach to this than how I personally trade it, but the basic concept is the same, and it is looking for areas where the market is very likely to react from. So most people know in the trading space, at least I think so, is that a very simple thing like a moving average can be used by price as an area where the price bounces from, like you see over here. Price retraces back to this area, and then it creates a swing. Like here, it creates a deep pullback. Then from this reaction from this line, like it's maybe not what you wanted to in a trade, but still you can see price is reacting to it. Sometimes it disrespects it, like here it also reacts from it, and sometimes yeah it just doesn't work and price just shops around it. But that's your job as a trader, is to look, okay, we got a trend, we pull back, okay, now is the time to take a trade. But in a situation like this, maybe it doesn't work because, well, price been hanging around the area too long and it's been disrespecting it. So I wouldn't take a trade here personally. But the main idea behind this strategy is, okay, this is one moving average, and maybe some people can make it work. Like they trade it every day. They look at the chart. Okay, is there a smooth moving average close by? Okay, and they trade the reaction. They just go through the chart. Okay, which one is working good, and that's how they do it. But for me personally, I need some more confidence. That's where adding some more moving averages come in. Like this is a 50, this is a 100, this is a 200. And you can see like here, price just moves through the 100 but respects the 200. Here it respects the 200. So it's not an exact science, but where the beauty lies is you see this moving average cross where two moving average meet, and price has stayed a bit distance from this moving average, comes back, touches the double moving average, and bam, we got a move down back to the 200 moving average. So it's these areas, these points of interest I'm looking for. Like here, you have a consolidation. Maybe I would have stayed out of the trade. Here it doesn't work. Here it doesn't really work. But here you got an area, two moving average, prices staying in it a bit, finding buyers, and then it starts to make a move up, and you can see it's a very big move. Like it doesn't always work, but when the moves happen from these areas where you got multiple moving averages, sometimes the moves they just go parabolic, they go very hard because this is where more traders line up because more traders are looking at these moving averages. That's the idea. You look for areas where there are multiple players in the market looking for an entry, and that's where you have them carry the move down or up. So this is just the moving averages part. I also use exponential moving averages. They're not too different, but I know some people use the simple ones, some people use the exponential ones. So I just look for areas where a lot of moving averages combine. And also one of the things that I do So as a discretionary trader, I also just look at the price action. Okay, this isn't looking like anything trendy at all. So here I just ignore the moving averages because price has been chopping around them, you know. It doesn't look like, yeah, you have some reaction from it, but it doesn't look like a high quality setup. While, for instance, when you have a trending phase, price goes down to the moving average area. I look for some reaction here, price just moves through it, so don't take a trade. But when you have something like this, it goes to the moving averages. It creates like a V shape, it creates some momentum back up. Then I take a trade, put a stop behind the move or behind a zone or something, and then target a one-to-one and catch a nice trade. So this is the moving averages part. But then there's another concept which a lot of these discretionary traders use, which I implemented as well in my strategy, and I also got from Meet Matthew, is using the Fib retracement and the Fibonacci. For the Fibonacci, you need to find swing points. So a swing point can be like a very clear low or high on the chart. Take the tool. I use the control button to snap it to the low of the wick. Oh, wrong tool, my bad. Then you just draw the Fibonacci. I keep them simple. For me, it's just the 0.382, the 0.5, and the 0.618. I personally really like this one because it's like a minor pullback. But for instance, here you can see price move down, touch the 200 moving average, and it goes all the way back to the Fib level. Then it creates like some confirmation of the move happening, and bam, the move happens. So here also price stopped at the 0.382. It didn't have the momentum to go back up, but you can still see price is having some reaction to these areas. So that's very simple, but a very key thing in this is, are the Fibonacci levels still working? Like if you have a move like this, but price disrespect the 0.618 and it goes all the way down to 0.7 or something, then I just remove the Fibonacci. It no longer works and I look for another one. It's the same for the short side. You pick the highest high, you draw the Fib to where the lowest point market has been from that point, and you get these levels price can or cannot respect. So here another instance where the 0.618 level is very interesting. But the beauty lies in when you have a Fib like this, you draw it, and you see, for instance here, you get the Fib level, you got two moving averages lining up. So this is an area where a lot of sellers will be looking to take a trade. So you can put like an order here ready, like you take a short tool, for instance, when price was here, you enter with the level above the Fib, the 0.618, and you target something like a 1 to 2 or 1 to 1, whatever you like. And this is the basic strategy. But just having a Fib, it's not enough for me. I also use multiple Fibonacci's. So, okay, this is a low. You can draw a Fib from here. But you can also draw a Fib from this low. And as you can see, when you're drawing a lot of Fib levels like this, okay, this one got ignored, like it got disrespected here, but still, when you're drawing all these fib levels on the chart, it takes a lot of effort and it becomes very messy for the eyes real quick. Even still, you can use it to look for areas where there's a lot of lines, like here a double Fibonacci, or if you have a moving average here as well, that would be great. But yeah, it just gets really messy over time, and it's also still not the highest area of value for me. For me personally, I use even something else to confirm it, and that is just support and resistance from these areas, the same areas the Fibonacci comes from. So I would take something like this low, draw a zone, this high, draw a zone, maybe this high as well. And you can see price is respecting this high. And you can do the same for this low, and you can see a nice bounce from this zone. Maybe you also draw this one. And this is the most important part of my toolkit for me. It's drawing these highs and lows, extending them over the chart, and then, like you can see here, you have multiple highs coming at the same point. You have price clearly reacting from it, and this is where you can get a A+ setup, where you can know, okay, price is gonna respect this, the market is gonna go down. So this is the most powerful part, but even still here, it can get messy because you keep drawing them, and after a while, if you've been trading the same chart a long time, you have like a lot of zones, and if you keep drawing them, you also have to keep extending them if the chart were to move more and more. So even this is messy, even without the Fibonacci's and with the moving averages. So I created a program which does not display the moving averages. It does not display the exponential moving average. It doesn't even display the support resistance. It doesn't even display the Fibonacci zones. What it does is it finds a support resistance zone like this, creates a zone, and then inside the zone it's gonna look, okay, there's two moving averages inside the zone. Here is one moving average inside the zone. Here this one, here this one, here there's two in the zone. So the more confluences are in there, like the more moving averages are in there, the more Fibonacci's are in there, the stronger the zone becomes. And I gave each of the moving averages, each of the Fib levels, what I personally think is how strong they are. So I ranked them all, which is my secret sauce I'm not gonna share, but that way I know how to, for each bar inside the zone, how to know how strong it is and if I want to use it or not. And that's how I created the fat get zone indicator. Because as you can see here, there's a support resistance zone. Let me turn this all off. And there were some moving averages inside this. So let me remove everything from the chart now and see how clean the chart is looking all of a sudden. Like you have this support zone here. You see this line inside this. This is a Fibonacci level. It's also being colored because there's also more confluences in there. And you can see how a simple support resistance zone, it gets colored based on confluence. So not at every bar I would use this zone. But here you can see, because like we saw in the past, there were two moving averages here. There was a Fibonacci level here. Then you see a clear entry point to Fibonacci. You know where to put your stop. It's behind the zone. You know maybe even what to target. It's the next zone. You can see it's a clear area in between the zones. That's also another concept, maybe for another video, but it's actually, you can see you have a clear sky below it. There's not too much resistance here. you can know here already, okay, if price bounces from the zone, it has some space to move, I can grab a nice trade. And that's basically the magic of this. It's very clean. It combines a lot of indicators, a lot of things, which personally I didn't know an indicator would be able to do, like finding these support resistance zones, using Fibonacci extension, drawing tool, everything. It all does it automatically. Like you can even, if you show the entire fibs, um, and show, you see all these lines here. This is just the Fibonacci zone extending with the move going up and up. You can see the levels change. They call it the fat cat zones. And you can even just use it for the Fibonacci level tool. But personally, I only trade from the zones. And the downside of this is, okay, if you have a retracement to a moving average without it being a zone, you're not gonna be able to take the trade. But at the same time, why would you want to take every trade? Like I trade a lot of trading pairs. So what I just do is I go through all the chart, the indicator loads up quickly, and I can just see at a quick glance where are the zones, is price nearing them, is price respecting them, and if price is respecting them, like for instance here, if price were to move back to the zone, I could take a trade, target is high, and just have it really simple. Don't even have to think or draw. Like, of course, you need some mastery, of course, you need some skill, but it just draws everything for you. And I hope now that you know what's all behind this, all the moving averages, all the Fibonacci's, the pivot points, then you can know when you see a zone like this, you know, okay, why is it colored like this? Why would it work? So it creates some confidence to trade these. And here, for the example I was telling before, is yeah, I'm rambling a bit now, but it's raw. So you can see you have a zone, but the price is like not really respecting it. It's moving down, up, going through it. Here again, not really respecting it, only respecting it a bit. As you also see clearly, there is some resistance here at the top, so it can't really make a big move easily. So why would you even take a trade from this zone? You just ignore it. While on the other end, you see the zone below it, and you can clearly see price is reacting from it, it's reacting from it, it's reacting from it. So then you can just ignore this zone. You can see the sky cleared up, the resistance disappeared a bit. Price is making a strong move. It even moved quickly through this zone. You can just take a trade like this from this. Yeah, this is all cherry picked, but still, you can see the strong momentum. Put a stop behind the strong zone, target a 1-to-1, maybe a 2, or whatever you're comfortable with, whatever your strategy. I used to trade this in the past with a 1-to-1 risk to reward, but whatever you want to do. But that's just how these zones are created. Like here, you can see it requires some discretion. You can see price slowing down from the zone, and then boom, it makes a quick zone after hitting the Fibonacci level. But I personally wouldn't have hit this trade because it would already made too much a move after it confirmed to me, okay, this is reacting from this. And then you can see price is just not really respecting the zone too much, even though it's two zones. So I wouldn't really have taken this trade, even though it would have been a great trade. And I wouldn't have taken a short here because the market didn't show me that much of a reaction from it, and you have some support below it. So it's not perfect, Sometimes price just disrespects three zones at once, goes through it, goes back up it. Yeah, it is what it is. But for me, Forex is like a difficult market. It's like you can't really play the trends that well. So for me personally, in the Forex space, the only thing that really works well is bounces from support and resistance. So this is the one I'm trading. This is what I do. I wanted to keep it raw. And maybe to end this, I'll show you some results because I've been trading this. This is all one-to-one risk to reward. I saved all the trades I took, made a nice graph. Then when you go down here, I'm at 236 trades now. This is the updated graph. Yeah, we get some choppiness, but still overall the portfolio is going up, trading all these pairs. And take into account not every pair is really that tradable. So if you would have filtered down, used better trading pairs, maybe this equity would have been going up even more. So I just keep tracking this. I just keep trading this strategy, and I'm sharing it to you guys in the ChartMuse group. And I hope this helps you guys. I hope this can improve your trading. Peace.